Okay, yeah. So as far as cap rate goes, is it market dependent? Like, does each specific market have a cap rate? Because I remember you saying, ask your agent what the cap rate is.
Yeah, great question. So yes, each market has a different cap rate. So for example, in California where I'm at, it's probably between 2 to 3 cap. And in
Hmm.
Oklahoma, where I invest right now, Oklahoma City is probably like a 7 cap, but the more like tertiary markets in Oklahoma, like Enid, where I own my 20 unit, that one's probably like a 9 to 10 cap. So the best way to know cap rates, unfortunately, is either A, you just have to talk to brokers, as I kind of alluded to
Hmm.
earlier. Unfortunately, a lot of brokers aren't, they may not be as forthcoming with the information, to be honest.
Hmm.
And they tend to make it the cap rates a little bit lower than anticipated because it inflates the value,
Hmm.
right? Because you have your net operating income numerator, denominator is cap rate. So if you raise the numerator, you raise the value. If you lower the denominator, which is the cap rate, it raises the value as well. So,
Hmm.
so it while it is nice, it's hard to get an honest opinion. So the best source, to be honest, is you kind of have to buy a property to do it though. The appraisal report. So anytime I bought an apartment complex, the appraiser, they're going to give you analysis of the cap rate and they'll tell you what the market cap rate is for your asset. So that's how I know. So I got my 26 unit that I bought. When I got it appraised, it would say, oh, like Oklahoma City is, I thought it was an 8 cap when I was underwriting it, but they're like, oh,
Hmm.
7.5 cap. So it kind of went down a little bit, which is good for me, right? Because values go up.
Go up, yeah.
Then when I did an appraisal for my 20 unit in the tertiary market, yeah, it was kind of like a 9.5 cap. So after that, I kind of have a sense of what the cap rates are
Hmm.
um, to gauge. So it's no great answer. I mean, it's just kind of typically like the Southeast, like Alabama, Oklahoma, Missouri, possibly Georgia. They're typically like kind of like that 7, 8 cap range.
Okay.
They're more cash flow markets, right? It's more like cash flow versus like California, Arizona, kind of the coastal states. Those are like lower cap rates where you're not going to get as much cash flow, but you're going to have more natural appreciation.
Hmm.
California, like I'll be honest, like my single family homes I own in California, like geez, they just break even, and that's not even including like property management. I self manage it, and if I have one like repair I need to make, that's technically my negative.
Hmm.
But my single family home that I first bought, 6 years ago, appreciated by $600,000 in 6 years, which is like 100K a year on average.
Yeah.
So, you kind of apply that to apartments, kind of the same thing. Like in California, where I'm at, even the apartment I'm staying in right now, I mean, I'm paying like 2,200. Um, but like, the apartment that I'm living in, it's probably like, I don't know, 300,000 per door. So
Hmm.
you're not even hitting that like, 1% rule, or so people call it.
Yeah, you should be
It's
getting.
more of the natural appreciation because, like, California, I mean, it gets a lot of hate, on social media, but at the same time, there's a lot of jobs here. It's great weather. I mean, it's like people will come, like people are leaving, but people are also coming. So it's just kind
Hmm.
of um, how it is. So yeah, like Oklahoma. That's why I chose the Southeast to invest in because I wanted higher cap rates because I'm gonna have more cash flow. And for me, I'm really focused on cash flow right now because I'm trying to leave my W-2 job. And then eventually, once I leave my W-2 job, at that point, I could potentially, maybe start investing in small apartment complexes in my market in California. But I know that it's more of like an appreciation play versus cash flow. So you kind of want to diversify, right? You might have California over here, which is all appreciation, and then you have like the Southeast states, which is more cash flow. And together, they kind of like create a well balanced portfolio, I'd call it. Um, so yeah, I hope that answers. Do you have a market specifically that you're looking at?
Yeah, I'm in the Atlanta market. And I have a couple of deals that some of the people I'm associated with they closed. And I was looking at I guess it might have been the OM.
Oh
or the
yeah.
appraisal, but it showed that it was 6.2. It was showing 6.25, 6.75, and I was trying to see how did they get that figure because I did use the NOI divided by the purchase price, and I was still not coming up with the figure. So I don't know. I was like, is there something I'm missing? Uh, to get the cap rate.
Yeah, I mean, yeah, it's just the math equation, right? So value,
Hmm.
the purchase price equals NOI divided by the market cap rate. So you know the sales price, right, on the OM,
Hmm.
and then you know the NOI that they're giving you. So it's just kind of basic math where you're dividing the NOI divided by the purchase price and then times it by 100, and then basically you'll get your cap rate. But the issue with the offering memorandum. I'm not sure. I might have
Hmm.
said it in one of my prior videos if you binged it, but it's I call it. It stands. It means lie in Latin. The offering
Hmm.
memorandum is always fabricated to justify the price that the broker wants to sell at. So what happens is that NOI. So NOI is income minus expense, right? That's
Hmm.
basically the equation. So what they do is the income might be accurate, right? And how do you verify the income's accurate? You need a rent roll, right? So how I do it is, let's just say, for sake of simplicity, the rent roll says 10K a month.
Hmm.
So if you times that by 12, that's the income of 120K, right? So you can kind of gauge right there. So if you look at your rent roll, times it by 12, and there's a discrepancy between that number versus what the actual income is, and I usually give about a 10% discrepancy, it should raise some red flags to you, like
Hmm.
what's going on here, like what is fabricated, right?
Hmm.
If they're within like that 5%, 5 to 10% range, I typically feel at least a little bit comfortable to say, okay, it might be honest. But the second part of the equation is expense, right? And you get to look at the expense ratio specifically. So if they don't put at least 50% for expense, it's probably fabricated.
Hmm.
So if your income is 120,000, your expense for simplicity is going to be 60K. And
Hmm.
this includes everything, right? This is property management, any repairs, any water, trash, common area electric, insurance, and this is all before your debt, your loan payment.
Yeah.
So if they don't, so a lot of offer member, as you look at it, it'll show, oh, the expense ratio is 35%. I know, like, there's no way an apartment is 35% expense ratio, right? If
Yeah,
you ever
this one
see,
was showing 31.
oh yeah, that's right out the gate. That's already a lie, right? Because at best, you're talking about a mobile home park without any tenant owned with all tenant owned homes, or you just rent out they just pay you for the lot rent. That's
Hmm.
around 35 to 40%. So the fact that they're saying an apartment complex, and how old is that
Hmm.
apartment complex? What age is that apartment?
1960.
Okay, that's like mine. Okay, my both my apartments are 1970s.
Hmm.
Those are called C-class apartment complexes,
Hmm.
which means they're value add apartment complexes, which
Yeah.
means that you're gonna have to put in a lot of renovation, fix them up, bring it up to code, bring it up to modern day standards. Maybe they done that on the deal and they're trying to sell it, but it's just kind of like from my experience in Oklahoma, my expense ratio is 55%.
Hmm.
And it shows on both my units, my 20 unit, my 26 unit. So like the fact that they're saying 30%, like that, I right out the gate, I would already round it up to 50%.
Okay.
So like that's why I said like it's completely fabricated, and typically you want to ask for the T12 and the rent roll.
Hmm.
So the T12 is the actual profit and loss statement. So so basically the offering memorandum, it's just kind of like my joke is the longer it is, the more pages it is, the more they're trying to hide and lie.
Yeah.
Yeah, and I'm sure you might saw one of my videos. I think like I underwrote like some A class 50 unit.
Oh
Um,
yeah, the $4 million one.
yeah, and I
Yeah.
think I came up like it was like 1.5 or $2 million overpriced or something.
Hmm.
And like, and so not like you wasted time, but like this is how you build the reps, right? Like once you
Yeah.
look at these deals, you're gonna start to see like why is the expense ratio always 30%? And to me, it's just like why are these real estate brokers blatantly lying to me? Like they've been in the industry for so long. They always talk about like, oh, I've sold transact $200 million worth of real estate. I'm like, but I did 2 deals, not even 2 deals, and I already know the expense ratio. It's not 30%. Like, there's no way that's remotely possible. And then if you look at their insurance costs, it's usually way too little. Like, if you look at their insurance, like, did they list how much the insurance is on the OM?
Let me see. I just had a quick snippet of it.
Sometimes they show it, but sometimes they don't. But like, it's usually way too low. Like one time I looked at a deal. I think the deal I looked at, it was like 5K. And I know for a fact, like, my insurance policies right now are at least like 14K for my 20 unit and 22K for my 26 unit. So it's replacement cost insurance. This is good insurance, right? So if they quote you 5,000, it's the cheapest insurance ever. That basically, it's just for the sake of having insurance. That's it, but it doesn't do anything. If your apartment burned to the ground, it's not going to do anything for you. Like, it's so bare bones. So that's why I came to the point where, like, I give brokers a hard time a little bit, but I've never gotten a good deal off LoopNet. I've never been given a good deal from a broker. But I underwrite those deals just for me to practice and for me to kind of learn about the market a little bit. So it's kind of more of an exercise for me. But I have brokers send me pocket listings all the time in Oklahoma, or in my market. I can look at a deal in like 2 minutes or less, and I already know what questions to ask. I'm like, all right, if you want 65K per unit, every single unit better be renovated, because that's the value for a C-class apartment complex right now.
Yeah.
And that you're talking everything new, right? New kitchen, new floor, new bathroom, new paint, new roof. You're everything renovated. But they're trying to sell at 65K per unit, and only half the units are renovated. So I said, in that case, I'm only paying 65K per unit for half those units, and the remaining units that are not renovated, you better be selling me at a discount. Right? Because maybe I'll buy it for 30K per unit. I'll put in 10 to 15K per unit, be all in for 45K per unit, and it's worth 65K per unit. So my margin is 20K per door for the remaining. So that's kind of how I look at it. And then I just said, well, if you want me to buy 65K per door, I'll pay that, but give me do creative financing with me. Give me terms. So that's always my back pocket, where if you're so adamant about price, I'll give you price, but you give me terms. The terms have to be favorable for me. So I can cash out and then do the value add and make sure when I cash out refinance that the value is justified to pay back this higher price down the road, right? So that's just kind of how I think of deals at a very quick level.
Am I able to, because I think this looks like the appraisal, am I able to share my screen? Is that?
Yeah, go ahead. Do you have does it let you?
Let me see.
Let me see if I can give
window. Okay, yeah.
Does it allow you to share?
Yeah. Are you?
I can see it.
Okay, let me blow it up. So I think this is from the appraisal, because I was looking back and it says date of inspection. And so, I mean, yeah, you have the information right here. Purchase price 2,100. And then these are the financials. So
they want 2.1 million, or how much?
That's what they purchased it for.
Okay, how much are they trying to sell it for?
It's already been sold. This is just a past deal that I was going over just to see, what the numbers look like.
Do you know how much it was sold for?
It sold for 2.1. I don't remember what it was listed for.
Okay. Yeah, so out the gate, why I asked that was because I want to calculate price per unit, right? So that 2.1 million, this is a 17 unit.
Yes.
So it's about 123K per door, right? So out the gate, if you want the 1% rule, your rents have to be about 1,200 per door. And I'm not sure if this is hitting it, but this actually looks exactly like my 26 unit apartment complex. This is typical, right? C-class value add. Right here, where it's 17 units, it's about 12,000 square foot. That's as big as my 20 unit. So I guarantee you the insurance, if it's similar Georgia is similar to Oklahoma. This insurance is probably about 14K.
14,000.
And because it's
Okay.
17 units, your expense ratio, I guarantee you, it's about 50 to 55% minimum.
Mm-hmm.
Because it's like mine, right? This is like my same exact asset class.
Yeah.
And the fact that it's the 1960s, same thing with me, right? You might need a new roof, maybe a new electrical, things start to happen, right? But it's nice that they sent you this appraisal report. I like that transparency at least, right? Because it means a
Mm-hmm.
lot if you can show this. So here it says flood hazard zone. I'm not sure it's zone X. I'm not sure what that means, but that's another concern with insurance, right? If it's in a flood zone, oh my God,
Mm-hmm.
good luck with insurance, right? Because they'll see it's on the map. And what I hate about buying in flood zones is that it's out of your control. Let's just say it does flood there, right? Your insurance will be so volatile. Like a lot of people will pull out. They won't want to renew your insurance policy. And it may double or triple how much you pay. That could
Mm-hmm.
be catastrophic, right? Imagine you're paying
Yeah.
like 14K and all of a sudden they double it to 28K. Geez, I mean, that's eating your cash flow right there. Like
Yeah.
you're done. So that's why I actually, like in my course, I have a video about deals not to buy, and one was areas in flood zones. Because for me, it's just too much risk for me. Like for me, I buy and hold real estate long term. I just don't
Mm-hmm.
want that risk of being in a flood zone, right?
Mm-hmm.
So for me, if I were to get this type of deal under contract, honestly, I'd probably just try to wholesale it and get that quick profit,
And
right?
actually drove past the property. I don't think it's because it's in Midtown, like in the
Okay,
center. So there's no way. I think the zone X. I mean, it's not.
it's not in the flood zone. Okay,
Yeah.
yeah, then that's good then. So thanks for sharing that because yeah, but
Mhm.
that's my thought on like flood zones, right? Just for
Yeah.
your education. And then let's see here. So basically, usually you'll give the financials honestly to appraisal, but they look like they lied a little bit. I'm not gonna lie, but right out the gate, basically it's 270K. Expense ratio is 31%. No way. No way is it
Hmm.
31% out the gate, right? So they're trying to justify a higher value,
Right.
right?
Yeah.
And they say it's 95% occupied, stabilized. And right here they have valuations, right? So income approach as completed, stabilized. So this is assuming that you execute this plan, right? What's the plan?
Hmm.
Are you renovating everything and you're going to rent it at market rent? That's probably what they're referring to. So they think
Yeah.
that's worth 3 million, right?
Hmm.
And as is, it's worth 2.2 million. So this guy bought it with 100K, 150K equity day one. So that's good,
Hmm.
right? That's good. And then sales comparison approach. So typically that's price per unit, right? So
Hmm.
basically that market, same thing. They think it's about 175K per unit of fully renovated, and it's gonna be worth 3 million. So once again, it's a good sign, right?
Hmm.
But my only concern is like I think they fabricated the expense ratio. Like I don't know how they got that expense ratio of 31%. Like no appraisal should take that, right? Like I don't even know how you can just, especially for a 17 unit apartment complex. Like if you're talking like 200, 300 units, maybe I would buy it at 30%.
Hmm.
But even then, at 300 units or 200 units, you're talking A-class apartment complexes, right? At that point, they typically
Hmm.
have a pool, they have a gym, they have a kind of a business area, and it costs to maintain that. So it raises your cost. So I don't know how he got that, but that's probably how they justified higher, um, a higher appraisal value. So if let's
Hmm.
just say in a year or two they execute the value add strategy and the reality of the expense ratio is 55%, well, guess what's going to happen to the value? It's not going to be 3 million.
3 million. Yeah.
It's going to be down, right? But
Hmm.
even with that, you have to look at your margin, right? So I would underwrite this deal assuming 50% expense ratio,
Hmm.
that valuation, and then if it's a good margin of how much you buy it at, how much you're putting in to renovate it, and then the final price. Like if you're all in for 70% of the ARV, you're good, right?
Hmm.
So, I'm not knocking the deal, but like you just have to like be realistic with the underwriting. So 31 out the gate, that's impossible for a 17 unit. I mean, unless you're self-managing that thing. and buying the cheapest insurance and and not really fixing
Like,
things.
yeah.
So yeah, is there more to this? Can you scroll down a little bit? Let me see what else is.
No, that's
Oh,
actually
that's it.
all I have from it.
But yeah, this is great information, right? So
Hmm.
now that I see this, I do think this is in like Atlanta, Georgia. I mean, it's a hot market. I know.
Yeah.
I believe it's probably around a 6-7 cap. It's a little bit hotter of a market, I'd say, compared to like where I'm at in Oklahoma and Alabama, Arkansas, Missouri. Those are like a little bit more like 7 to 8 cap. So I think it is safe to probably assume you're probably at like a 6 or 7 cap. So this is
Hmm.
a C-class apartment. So they're saying about 6.25, but an A-class, you're probably going to be like, usually it's about 1 cap rate lower. So if it's an
Hmm.
A-class, you're talking about 5.25.
Okay.
And that's about right. So, and the B-class is like usually in the middle, right? So it's going to be like the
Hmm.
midpoint. So that sounds about right, I'd say. But like I said, the only thing fabricated here in my mind is the expense ratio. Like, no way. No way.
Okay. Yeah.
And do you know
Are
what rents
you?
are for this area,
What's
for
that?
that type of unit?
For rents. Let's see. That's the thing. I I've actually heard of the area before, and I know it's not the best area, but like the like in the little pocket that it's in, but you know, 5 minutes away, it's like super nice. It's like West Midtown. So it's like you can get rents probably. I want to say maybe like 1,300, 1,200, like you said.
Okay. So it's like a one bed. Is that for a one bed or two bed? For that
Um,
1300 range.
that'll probably be for, yeah, one bedroom house.
Okay. Yeah. So like right there, like it hit the 1% rule, right? So
Hmm.
I do think if these numbers are true, minus the expense ratio, like I think it's still a good deal in my mind,
Hmm.
right? It may not be worth 3 million, especially at these interest rates today. But if you stabilize it over the next few years and hopefully interest rates go down and your expense ratio is around 50%, like I still think like this will be a pretty win cash out refinance, assuming you
Hmm.
did it well. So, you can learn a lot from this deal. So I thought it's not terrible um, for this. And, it's probably in the path of progress, but you're local to the market, so you can drive by. Like for me, if I'm doing due diligence, I drive by multiple times a day, right? You want to go
Hmm.
time, nighttime, weekend, weekday. Are there people loitering out there? Does it look kind of sketchy? Is it near like a liquor store where people just kind of sitting out there? Do people loiter, or is it kind of more like your average, workforce housing? They just
No,
kind of
this area is kind of sketchy.
yeah, and that's why maybe they buy at a margin, right? But I'm learning
Hmm.
my mobile home park that I'm selling right now. Oh my god! And in Selma, Alabama, like don't compromise location. Like the headache and the stress that you deal with for location, like no amount of money, unfortunately, no amount of money can fix a bad area.
Hmm.
Like you can pump in as much money as you want, but if you don't attract the right tenants, you'll never change that apartment or that asset around. Like my
Hmm.
20 unit, man, the client, the renters I inherited, they weren't the greatest, right? And I came in there, a lot of them left. We evicted a few, but now we're bringing in better tenants. And then these tenants are like your workforce housing, right? They're kind of like younger, they work, they're quiet, they play by the rules. And once you start to get a couple of those in there, it kind of compounds, right? Because it'll attract other people. Like, oh, it looks like a great area, a great place to live in. So you kind of change your reputation immediately. And because mine isn't, I would say it's kind of similar location as this, where it's like, yeah, it's like a little. Unfortunately, homeless people were like kind of hanging around there, but
Hmm.
because the renters were kind of letting the homeless people hang around there. But now these new tenants, they don't allow that. If they see homeless people, they'll call the cops. We installed signs that say no trespassing. So if the cops come, the cops can say, they can point to the sign and say, hey, you're not allowed to trespass here. It's private property.
Hmm.
They have some basis to kick out the tenant or kick out these transients. So it might be like that, but yeah, you have to really see the area and like, as you know, in real estate, like, so what I would do is I'd get my property manager that you're working with, or it's whether yourself, but like I'd ask multiple property managers and say, hey, I'm looking at making an offer on this property. What do you think about this address? And if sometimes they immediately said, oh my God, that's Homicide Alley. Don't do it.
Yeah, most
And
of
then
them.
you run. You run from that deal. Don't even waste any more time. And now you know it's a bad area. That happened to me. I was looking at a deal in Tulsa, Oklahoma, which is kind of the income
Mm,
market in Oklahoma. And I had a great deal. It was like a 50 unit. He wanted 2.5 million. He was willing to seller finance me the deal. Like he said he wanted a 20% down, but he said that I said, hey, can I do 5% increments over 4 years? So 5%,
mm-hmm,
5% in the year one, 5% year two, 5% year three. And then the
mm-hmm,
cash flow would cash flow enough that it would cover that 5% every year.
mm-hmm.
So if you think about it, it's almost like you're doing 5% of
Three,
your
yeah.
right. So that's how I structure creative deals. But I brought that deal to 3 property managers, and immediately they said, "Oh my God, that's Homicide Alley." Like my kid goes to school nearby there. There's a private Christian school there, and we just saw like the cops investing in homicide right there. So out the gate, I was like, no wonder he was willing to seller finance me that deal because
Mm-hmm.
the area was too bad. So by asking these property managers, they're kind of like your big brother, big sister overlooking behind you. Because if they don't want to touch it, you don't want to touch it. Right.
Yeah, yeah. They
So
don't want to step foot on there.
yeah, so that's
Yeah.
why for me, like if the numbers check out, the next step I do is, if I'm local, obviously I'm gonna drive by various times of the
Mm-hmm.
day. If I'm not local, I'm gonna reach out to my property manager. If they say, the area is decent, then typically I'll ask, hey, like I'm thinking about making an offer on this. Can you just drive by this property during various times of the day and let me know? Take some pictures, see what you see.
Mm-hmm.
So they're kind of like your boots on the ground for you. And if that checks out, obviously then you start making the offer and then do your on-site due diligence if they accept your offer. So, um, yeah, I think it's that's what I would kind of do, right? So this area is kind of like it seems like it's maybe a C minus area. Like it can maybe become a C, but maybe it's kind of near D. So,
Mm-hmm.
but like I said, it's not worth. And I guarantee you, if you have bad tenants in there, your expense is not going to be 31%. Like evicting
Mm-hmm.
somebody, I'm not sure what the eviction laws are in Atlanta, Georgia, but in Oklahoma, 15 days, you're out in 15 days.
Okay.
And usually people know that. So once you give them eviction notice, they're ready to leave before the 15 days because they don't want to deal with the court and have it on their record. So they usually
Mm-hmm.
leave. I assume Atlanta is landlord friendly, but I don't know.
Yeah. Um, Going back to this, I was looking at the numbers at a 50% expense ratio, and the gross, or excuse me, the net operating income is like 136K instead of 187. And then
Yeah.
once you do that by the cap rate, you're at 2.1
Yep.
million. Um, and I mean, it's 2.186 is the full amount. So would you say that this is a good buy given that you're running it at 50% expense ratio?
Yeah. So
And
the cap
mhm,
rate going to be like what half the income is 135K roughly, and then you divide by 2.1 million, so it's a 6.45 cap. So
mhm,
that's not terrible, but then like that's stabilized. It's a 6.25, right? So you only have a 0.25 margin in cap rate for your potential, right? So
mm.
that's how I kind of think of it too. So for
Okay,
me,
so this is a stabilized number.
yes, you're
Okay,
buying it at a 6.5 cap, but stabilized at 6.25 cap. That's not much of a margin. But
okay.
that's assuming if you raise rents, obviously, then there's your margin. So for me, if I were to underwrite it, this is how I would do it, kind of quick and dirty. Basically you take the income, cut it in half, you assume you down 25%, assume that you could probably get between 25 and 30-year amortized loan and interest rates today, assuming you have a good debt to income ratio and your W-2, you're 7.5%. That's what you're getting, right? So at that point, you can calculate what your debt service is, and then you can calculate your net cash flow. Then once you have that net cash flow, you times it by 12, and then you divide it by your down payment, and that's your cash on cash return.
Okay,
So
you kind of lost me.
yeah, that was
With the
fast.
maps. Yeah, that was very so I know you're saying, increasing the rents, and then after that, it was just that math, like the math. I was trying to get it done because that's how you're calculating the margin, right?
Yeah. So let me actually run the numbers right now. So let me
Mm-hmm.
calculate the mortgage for you.
Okay.
Um, so basically, you got a $2.1 million loan, right?
Mm-hmm.
So if you down 25%, you basically need about 525K down.
Yeah.
Yeah, so write that down, right? Write that down for me. And
Mm-hmm.
then your loan is going to be 75% of 2.1 million. So at 75%, you're talking about 1.575 million.
Mm-hmm.
That's your loan, right?
Mm-hmm.
So basically, I'm going to put this in the mortgage calculator. So 175, and I'm going to assume you're getting a 30-year amortized loan. I think I'm getting it on my deal, so I know you can get it, right?
Mm-hmm.
Interest rate, I'm going to assume 7.5, but this is the best case. So right out the gate, your monthly payment is $11,000 a month
Mm-hmm.
for the loan.
Yeah.
So let's backtrack now. So the gross income was 273K,
Mm-hmm.
right? Let's cut that in half. So you have 136K of annual income, right?
Mm-hmm.
Now
Yeah.
let's divide that by 12 to find the monthly income. So now, guess what? Your net operating income after the expense is 11K a month. But guess
Mm-hmm.
what your mortgage is?
11,000.
So you break even, right? So that's usually most deals. So like in that case, either A, you have to put more money down and you get more into the deal, or B, you have to lower the offer price.
Mm-hmm.
And I guarantee you, based on my experience, the moment if you were to buy this asset and it's truly value add, we're assuming we're getting 11K a month in rent right now, right?
Mm-hmm.
So 11K a month, let's divide that by 17 units. That it's averaging $650 per unit.
Mm-hmm.
That's not that much, right?
Yeah.
If the market is around 1,200, the rents are averaging half almost.
Mm-hmm.
So basically, that's could be your value add, right? Like if you truly can buy at a good price, not 2.1 million, and you're able to renovate these units for 15 to 20K each, and then you can double the rents, that's a home run, right?
Mm-hmm.
So at this point already, see, like this is at a 7.5% interest rate, right? You're breaking even,
Yeah.
but let's say reverse this back to when I bought my deal. 5% is what I had 4.5%. My monthly payment is 8,000.
Mm-hmm.
Dropped it by $3,000, right? So my income was 11,000, right? After the expense. Now minus 8,000 for my um, debt service. I'm cash flowing 3K a month on this property.
Mm-hmm.
And let's times that by 12. So in a year, we're making 36K in net cash flow a month.
Yeah.
And let's divide that by our down payment because to figure out our cash on cash return, right? So that was
Mm-hmm. Yeah.
at that point, you're getting a 6.8% cash on cash return. So honestly, you rewind this deal 2 years ago with interest rates at 5%. I think it's a good deal.
Mm-hmm.
And that's a
2 years
5%
ago.
or
5%. Yeah.
4.5. Yeah, like
Yeah.
at 4.5, that's a good deal. But that's the power of interest rates, right? Like at this point, it raised it by 3% and you're breaking even.
Mm-hmm.
So, it really depends on your strategy, right? Like, okay, if you pay that price and your interest rate is 7.5%, like, first of all, the bank's not going to lend on it because you need a debt service coverage ratio of 1.25.
Yeah. Most are money lenders. Yeah.
But your DSCR is 1 because your income is
Mm-hmm.
exactly your debt service.
Mm-hmm.
No margin. So out the gate with these interest rates, it's overpriced. But at 4.5% interest, you got yourself a deal. Like I'd say it's a home run deal. I mean, if you can make $3,000 a month, like out the gate, and in reality, when you take over, probably a couple of tenants will leave and stop paying you. But hey, let's just say that cash flow gets cut in half to 1,500. Hey, you got $1,500 extra to like start renovating these units, for a value add
Mm-hmm.
deal. So that's how I kind of look at the deal at a high level. But that's what kind of screwed me because I'm doing a cash out refinance right now, my 20 unit, and my
Mm-hmm.
interest rate 7.5. If I had a 5% or 4.5% interest rate, oh, this deal would be done already. I wouldn't have to like be begging my lender to like tell my story, and the ARV would probably be like 200K more, at least 100K more.
Mm-hmm.
So that's what's like unfortunate of interest rates. Like, it just makes it harder for like, people like me and you to like get deals, right? Kind of get deals. So in this case, like what I would try to do is honestly, like if I was negotiating with the seller, I would say, hey, look, if this, if the interest rates were, 2 years ago, I would pay this price of 2.1 million, right? But
Mm-hmm.
7.5% interest, I'm breaking even, and the bank won't lend on it. So the debt service cover ratio is a ratio of 1. That's me
Mm-hmm.
1.5. So I would just say, hey, like either A, we got two options. Either A, you lower your price, and this is the
Mm-hmm.
price that makes sense based on the DSCR. So you can backtrack, right? So basically, what's your loan amount to hit that DSCR of 1.25? Easy, right? You just take the your income,
Okay.
your income, and then you basically need times or divide it by 1.25. So
Mm-hmm.
your monthly loan payment has to be around 8,800. So
Mm-hmm.
backtrack, right? What's the loan amount? That's 8,800 a month, and then that's from there you'll figure out your offer price. That's option one.
Mm-hmm.
Option two, which hopefully sounds a bit better to the seller, is hey, I'll give you 2.1 million, but can I take over this property subject to if there's a loan on it? And
Mm-hmm.
I'll just make the payments on your behalf. I'll pay you, and then you pay your lender.
Mm-hmm.
Inherit their interest rate. Hopefully, it's lower than 7.5. Probably,
Yeah.
right? And then the difference between that loan and how much I'm paying, I could also pay you some interest on that money as well, right? So let's say
Mm-hmm.
he has he's selling for 2.1. Let's say he has a $1.5 million loan on it. That 600K margin, you can pay him the interest rate on that money as well, whatever that is.
Okay.
So in that way, you can basically get in the deal of maybe low down or zero down. Hopefully, you'll still cash flow, have the money to renovate it, raise the rents. In this case, we can potentially double the rents, right? Because what you're telling me,
Mm-hmm.
let's just take 1,200 each unit times 17 units. That's 20K a month in rents.
Mm-hmm.
So if that's truly the case, you got a pretty good margin there. So at that point, you would go in, renovate a couple, like 4 units at a time, usually, rent those out, see what you get for rents, right? If you hit your rent, great, continue those renovations. If you don't, let's say you think you're getting 1,200, but you end up getting 900. At that point, you're like, you know what? Maybe I don't need to renovate these as nice as I thought. Just do basic rent readies, make it just lipstick on a pig, right? Type of thing.
Mm-hmm.
Make it presentable, make it clean, make it functional. And it may cost you maybe 5K to do that versus spending 15 to 20K per full renovation. And at that point, you can do a more affordable units. So that's basically how I do my units, right? Like I'll renovate the first couple pretty nice, like really nice. And then I'll test the market. If it does well, great, continue. If it doesn't, then I'll say, you know what? I don't need to renovate these as nice as I thought because the market doesn't demand it right now.
Okay. Yeah. Smart.
Yeah. Yeah. So yeah. So that's a quick, so kind of summarize old interest rates of 2 years ago. I like the deal, right? Assuming it's
Mm-hmm.
not a bad area. If it's a
Yeah.
bad area, even if it cash flows 3K a month, walk away. Don't do
Mm-hmm.
it. It's if you have one bad deal, one bad experience, it'll make you hate real estate forever. Right?
Yeah.
I'm a mobile home park. I'm having such a bad experience right now. I never want to do mobile home parks again after I sell this.
Mm-hmm.
And I was stupid to diversify from apartments to mobile home parks. And the first, I should have doubled down on apartments, right?
Mm-hmm.
Shiny object syndrome. But so if the numbers make sense, but it's a bad area, not worth it. Like just walk away. Worst case, you can get under contract. You can try to wholesale it, make quick, 50K or whatever on the deal, and maybe someone else will do it, right? So that's how I would do it. Like, if it makes sense number wise, but I don't like the area, I would just try to be honest with the owners and hey, like I want to give you your offer price, but I'm going to try to honestly wholesale it and find other buyers who may like the deal, and I'll just be transparent throughout the process, right? Like so, you're
Mm-hmm.
not trying to pull their leg, right? Like what my current buyer is doing from a mobile park, he's like just not communicating at all on the last week before we're closing. And it's just kind of like, okay, what's going on here?
They're
Just,
getting rid of it? Like you're selling it right now?
yeah, I'm actually in the process of trying to sell it, and we were supposed to actually close today. And then the buyer just went MIA, just went off the planet of the earth. I'm like, all right, well, if you're going missing, that tells me my answer. Maybe you're not serious, or what's going on. And if that's the case, we just terminate the contract and I keep your earnest money deposit.
Yeah.
So, but that's what I learned is, yeah, it's like I should have done a little more vetting on the buyer that I was working with. That's why I like working direct with people, like
Mm-hmm.
you're the seller. I want to talk to you directly versus I talk to my broker who talks to your broker and that broker talks to you. By the time it gets to you, the message is like already misconstrued, or it's like playing telephone, right? So that's what I hate. Like, that's why I hate honestly working with brokers. Like from my experience so far, they've hindered me more than helped me. Like, I'd rather
Mm-hmm.
just go straight to the owner and, hey, let's just make this a win-win situation, right? And after working with this buyer that's like so flaky, it made me realize how great of a buyer I am. Like, I'm the easiest buyer to work with. Like, you text me, I communicate immediately.
Mm-hmm.
Like, and I think what happened was he's trying to raise money. He just doesn't have the money raised yet. And he doesn't want me to cancel the contract. But instead of just saying, hey, I need more time to raise money, he just,
You just want ghost. Yeah.
yeah, he's just ghosting me. And I'm just like, all right. And maybe this is how they do business in mobile home parks. It's an older industry, right? It's more people with like, the gray hairs, the white hairs. And that's the old way of doing it. But, I'm a millennial, and millennials, we like transparency, communication, and, just tell me what you need. And I'll be pragmatic about, like, hey, if you want more time, then you have to pay for an extension. If you want to extend the contract, it's going to cost money.
Mm-hmm.
Extend, but just be transparent. And if you need help raising money and you tell me, I'll help you raise money. Right?
Mm-hmm.
It's just basic things like that. Like, they think like by withholding information, it's actually helping them. Like, no, like, if anything, no communication means that you're not serious about the deal. So like, why would I trust anything you say afterwards if you're not
Mm-hmm.
transparent, not communicating? So it's just kind of funny. And like, and the broker was giving like some like non-answer, that political dance around where they kind of answer but not really answer. And I literally just told the broker at the end, like, you just answered the question about answering the question. And he just got really quiet. I'm just like, dude, this
But
is your.
he's out of financing contingency, right? So
Yeah, no, the contract's already over. Like, it was
yeah.
supposed to close 2 days ago. So technically the contract's dead. Like,
Yeah.
the contract's done, right? I'm just like, at this
Mm-hmm.
point, I'm like, you want more time? Give me money. If not, or we close tomorrow, or, I just move on. So
Mm-hmm.
it's pretty eye-opening to me. So what I'm kind of learning, which may sound counterintuitive, it's actually easier to buy than it is to sell.
Mm-hmm.
Because when you buy, it's within your control,
Yeah.
right? Like, you have the money or not, or if you can raise the money or not. But as a seller, you're kind of left in the dark, right? And then for me, I was kind of, he was kind of breadcrumbing me a little bit, but like I thought he could do it. He had the money ready, but maybe not. Probably